Good morning. You're watching Business World Live. I'm Danie Laurel. It's 10:30 a.m. this Friday morning here in Manila. It's Ada. Let's go straight to our top story. The country's balance of payments posted an $80 million surplus in the month of June, the most modest in 5 months, with the figure reflecting the proceeds from foreign loans meant to bankroll the government's COVID-19 response. Data from the Bangko Sentral showed that the June BOP was a reversal from the $404 million deficit recorded during the same month last year. The June figure was also slimmer than the surplus of $2.43 billion in May. The balance of payments is a summary of the country's transactions with the rest of the world for a specific period. The Bangko Sentral attributed the June surplus to higher foreign borrowings by the national government, majority of which were drawn the second quarter. The central bank also points to a lower merchandise trade deficit. It now expects BOP to hit a surplus of $600 million by the end of 2020, representing 1/5% of the GDP. AIM economist John Paulo Rivera says the June figure reflects significant inflows of funds from foreign sources by the government to contain COVID-19. Ateneo economist Alvin Ang, meanwhile, says the country's ample reserves will be its buffer against weaker inflows from trade. He says that a large positive BOP at this time is showing a weak economy due to weak trade, but it helps to have more than enough forex buffers for short-term payables. Now for some COVID-19 updates, the government is now preparing a 20 billion peso budget for the procurement of vaccines for COVID-19, which they say should be available before the end of the year. In a post-SONA briefing this morning, President Duterte said he has secured China's commitment that the Philippines will be a priority in purchasing approved vaccines. Amid this, President Duterte vowed that the country will return to normal once the vaccines have been procured. Finance Chief Sonny Dominguez, meanwhile, assured that state banks will be able to handle the purchase of an estimated 40 million doses of whatever vaccine will be chosen by the Health Department. Dominguez added that the Philippine economy is already past its lowest point and that activity is already picking up. Metro Manila, some parts of Calabarzon, and cities in Cebu remain under general community quarantine as cases remain high in these areas. The country saw its biggest single-day rise in new cases on Thursday, with over 3,000 new infections, bringing the total cases close to 90,000. Recoveries also saw a surge after the Health Department reclassified mild and asymptomatic cases as part of it. Casualties, however, from the virus have reached nearly 2,000. COVID-19 response chief implementer Carlito Galvez said that the government's pandemic action plan is now in a critical phase. Malacanang said today that the government will implement more comprehensively targeted testing and contact tracing activities. Markets, of course, are closed here in the Philippines in observance of El Adha, but we do have a lot of corporate news and market news. Let's kick off with some global news. Take a look at my terminal here and how the U.S. had performed rather mixed. Dow Jones down by 0.8%, with the S&P 500 as well, but the Nasdaq actually up by 0.4%. Now, what happened over in the U.S.? They had reported the second quarter GDP plunging by 32.9% year on year. This after the first quarter GDP was at a 5% contraction. But even as this was a shocking figure and, of course, a record contraction for the country, that was actually better than what the consensus was expecting, which was a 34.5% drop in the GDP. But still, this is still bad news. It's still the worst outcome since at least the 1940s. Another thing that is worrying over in the U.S., the labor market improvement had reversed. The initial jobless claims were rising to 1.43 million last week from a revised 1.42 million. So the claims on joblessness are continuing to increase. However, the tech firms did not disappoint, and you can see that with the Nasdaq shares actually surging despite the GDP contraction over in the US. Amazon, Apple, Facebook, and Google had released their earnings, and they all seem to have weathered the pandemic. Amazon profit, for instance, was more $10.30 per share versus an estimate of $1.51 per share. So definitely beating that. Apple as well, Facebook beating estimates. Google did not beat estimates but was actually not as bad as was expected. But meanwhile, cases over in the US still at record highs at several areas. Florida, for instance, record number of deaths for the third straight day. Europe as well is seeing another wave of infections. France has an infection rate that has almost doubled over the past 3 weeks. Germany as well reporting the most new cases in about 6 weeks. Now over in Asia, I'll just pick that out for you. Asia is of course trading today in most parts. There's China PMI has just also come out. It had pointed to a continuing recovery in July. Let's see how the markets are appreciating that. You can see that the indices over in China are all in the green, very firmly. So Shanghai Composite up by 1 2/10%, Shenzhen up by 1 6/10%. Nevertheless, you do have Japan also having a flurry of data this morning. You can see it contracting in terms of the Topix, down by 1 7/10%, the DK 225 as well. So a lot of things going on here. Hong Kong as well actually had reported the retailers continuing to struggle in June. Retail sales by value falling 25% from 1 year ago. This is a 17th straight month of declines in terms of the retail sales over in Hong Kong. Nevertheless, you could actually see the Hang Seng maintaining gains there, up by 0.4%. Now, just a quick peek at our own local boards and how that closed the trading week, which was, of course, yesterday. Just after lunch break, we're still, of course, in the shortened trading days here. We did not manage to reach the 6,000 level all week, and you can see us closing down by 0.6% to 5,928.45, so still shy at 6,000. And this, despite that decline, though, AAA Southeast Equities, as Chris Mangon said, that it is still the smallest weekly loss that we've seen in the last 4 weeks. So down by 1 2/10% for this entire week. That's still not as bad as what we had seen for the weeks prior. Chris Mangon says the selling pressure is now waning. Buyers can start coming in to the market. However, there is still the question of hot money outflows continuing to batter us. We have a lot of uncertainty here. Foreign portfolio investments, this according to the Banco Central, fled the country's financial markets for a 4th straight month in the month of June. So this is called hot money. You can see on my terminal here the equity hot money, which is more than 90% of that, but there's also hot money coming in from fixed income. And we had a net outflow of $235 million in the month of June, significantly higher than what we saw in June of last year, but still lower than the $1 billion we lost in the month prior. So it's still better than before, but nevertheless, foreign funds continuing to exit. Nikki Mapa of ING says this is no surprise. Meanwhile, we have a lot of earnings to be digesting today. Let's kick off with China Bank. This, of course, is a sister company of BDO. BDO had released its earnings. China Bank net income actually rose in the first half, and that despite the fact that there was higher provisioning. Just like all the other banks, it set aside a lot of provisioning for those loan losses amid the ongoing coronavirus pandemic. You can see on your screens there, the first half net income was up by 24% to 5.2 billion pesos. That's despite provisions being increased 14-fold to 4.8 billion pesos. You actually see interest income, core business of the bank, up by close to 40%, and non-interest income up by 41%. Now, this on the back of the loans actually growing by 11% in the first half. China Bank CFO Patrick Chang did mention that in these uncertain times, they're adapting their strategies with prudence. Nevertheless, you could actually see it ahead of that release, down by 1/10%, trading at 19 pesos and 98 centavos. Another one, however, on the other end of the spectrum is IMI, as they reported losses yesterday. That is a loss of nearly $17 million after those lockdown measures for the second quarter, and that is versus a $5.5 million net profit that they saw last year. And this is on the back of revenues for the second quarter down by 54%, bringing their net loss to $21.5 million in the first half. They had shut down several plants across the globe, particularly in the Philippines, China, and Mexico, plants in Bulgaria as well, and the Czech Republic. So a lot of issues here in terms of the manufacturing plants closing, but they did mention they are optimistic it will start recovering in the next 6 months of the year. Shares in IMI also shedding together with the rest of the local bourse, down by 3.5%, 4 pesos and 63 centavos. Let's take a look at the retail space here. You've got RRHI also posting a 33% profit fall. That's on the back of the expected, store closures. This is, of course, a retail arm. A lot of their shops are in the malls. They had reported their second quarter net income down by 33% to 719 million pesos. That's on the back of sales down by 12%, bringing their first half net income down 4%. However, they did mention that they're aiming to boost their digital e-commerce. So some of this, they're launching a South Star drug website for the drugstore brand. Groceries as well will be online. That they also have investments in Beauty Manila and Grocery. So they're trying to pivot that. RHI closing in the green yesterday. That is up by 2.9%, bucking the rest of the local bourse. And finally, on the last front of the earnings, at least for today, you've got Holcim, another one that a lot of us had been watching out for. You had its rival Cemex also reporting let's say a contraction in terms of growth there on the back of construction being halted, of course, and the same is happening to Holcim. Construction halting is impacting Holcim, seeing a second quarter net loss of 88 million pesos versus a net profit that they had seen the same month prior. Their sales for the second quarter down by 43% and their net profit down by 71% in the first half of the year. But they did mention, despite the fact that they are seeing a recovery in June after the government had allowed construction to resume, they are still having very limited deliveries, particularly to the Visayas and Northern Mindanao areas, but they are optimistic of their future. Holcim up by 1.9% in yesterday's trade, trading at 4 pesos and 84 centavos. And I just want to take a very quick peek at FGen. This has been in the news as of late. There was a Valoras, KKR actually increasing their tender offer there, them starting their Bataan plant, and this now actually being one of the top 3 best performing stocks year to date. They are now saying they're allocating, at least for the parent company, Lopez, LPH, is actually allocating 29 billion pesos. Most of that, so 14 billion pesos, will be going to First Gen Corporation, which will be devoting it to, of course, that onshore LNG terminal in Batangas, which has been given urgency status by the government. The rest of it, so 11 billion to the property business, which is, of course, they own Rockwell land, and 9.4 billion to First Philippine Industrial Park. So you can see FGen actually benefiting from more good news there. You can see it on the uphill climb since March 19, when all the equities slumped. That's trading at 26 pesos and 95 centavos, up by 3.7%. Meanwhile, let me scroll down to the headlines that we are watching out for in terms of the markets and economy. The Trade Department will be accepting new applications for its loan program to small businesses. That's after it gets additional funding from the state banks. The DTI said its financing arm, SB Corp, already obtained an additional 1 billion pesos from Land Bank and the Development Bank of the Philippines. Currently, the agencies are just finishing up the paperwork. Earlier, the department had to temporarily suspend its loan program for MSMEs due to applications exceeding its initial 1 billion peso funding. The DTI said it may be able to borrow up to 3 billion pesos more from state banks if needed. The department may also source funds from its Pondo sa Pagbabago at Pag-asenso portfolio, as well as from stimulus packages being cooked up and the 2021 budget. Applications for the DTI's MSME loan program stands at over 23,000 and are worth over 3 billion pesos. More than 3,000 online sellers have registered with the BIR by the end of July. That's in line with the Bureau's issued memorandum circular last month that made enrollment mandatory among online businesses. The agency extended the enrollment deadline by a month, or until the end of this August. Now, of the total 3,254 registered online businesses by July, 97%, or over 3,100, were individual online sellers, whereas 3%, or 106, were listed as corporations. The BIR is again reminding businesses selling goods and services through online platforms of their tax obligations. In the memorandum, the agency said those who will be found operating online business without registering or declaring unpaid taxes will face penalties under the law. Aside from taxing online businesses, another criticized government move is the proposal to impose 12% VAT on digital services, which hurdled the House Ways and Means Committee on Wednesday. Moody's said the country's credit profile will remain intact, that's amid the pandemic, if the Congress manages to pass reforms urgently for economic recovery despite political distractions. Recall that the debt watcher kept its Baa2 sovereign rating and stable outlook for the Philippines early this month. Now, according to a Moody's senior vice president, Christian de Guzman, the country's rating was affirmed due to its manageable and affordable debt burden. De Guzman also notes the government's, quote, remarkable progress in increasing revenues compared to other Baa2 peers. However, Moody's said legislators are prone to a great deal of distraction, as shown by the fact that they are focusing on other issues such as the anti-terrorism bill and the ABS-CBN franchise. De Guzman said the challenge for Congress now is to move forward with meaningful economic and fiscal reform. It's official. After close to 140 days in a quarantine, which is one of the longest and strictest in the entire world, the capital of the Philippines and the bulk of the economic engines of our country will remain under a general community quarantine until such cases subside. Here to help us understand these implications, we have with us AJ Montesa from the Action for Economic Reforms. Good morning, AJ, and welcome to the broadcast.
Good morning, Danie. Thank you for having me.
AJ, let's kick off with that post-sauna brief that we had all watched earlier at 9 a.m. A lot of people were worried, especially investors, markets, business community, that we might be reverting back to an ECQ. But in fact, what is happening is we're extending the status quo. How optimistic are you feeling right now? How assured are you that this is actually the right way forward? Is this what you had been hoping for, or were we actually hoping for something less stringent?
Well, it seems that the administration is, when it makes its decision to lift the quarantine or not, it's focusing more on the economic impact rather than the health impact. As we can see, the cases have been going up, 2,000, 3,000 cases already, and if that was the sole basis, they should have maintained a stricter quarantine. But the reason that they're continuing with an eased quarantine or a general quarantine is because of the effect on the economy. And I think as a post-sauna assessment, that's something that the president really needs to focus on, containing or mitigating the pandemic, because our economic recovery will really be dependent on that. So the president in the sauna really dwelled mostly on the possibility of a vaccine, but he didn't give concrete steps on how well we can manage the pandemic. So there's a key role that the government needs to play to prevent the temporary shocks that the pandemic will cause from having permanent effects on the economy.
Okay, and we'll get to those exact temporary ways in which they can help. But just generally, do you feel that there's a clearer roadmap now, today, compared to the sauna a few days ago?
Well, yes. I think there's a clear roadmap as regards, for example, to the stimulus bill proposed in Congress, like the Arise bill. I think it's a good proposal that will pump about 1.3 trillion pesos into the economy. It will increase spending on testing. It will provide loans for businesses, for MSMEs, for example. It will provide credit access. So it will help ease the financial difficulties that many of the small businesses are experiencing, but it will also target some sectoral industries, for example, tourism, transportation, manufacturers, agriculture. All of these are targeted in the Arise bill, which will provide a recovery plan for our economy.
Is that Arise bill, the 1.3 trillion, so that's even post-pandemic, so to speak, is that enough? Are you actually on the camp, so some are saying, a lot of external global, let's say, watchers are saying that's not as high as the stimulus that we're seeing in all the other countries in Asia, whereas you've got our finance secretary saying that it's going to be very expensive. We cannot afford a bigger budget there. deficit. So which camp are you? Is that actually enough to quell the economic contraction?
Well, it has to be mentioned also that there's supposed to be a second round of the Bayanihan law, which will provide
Mm-hmm.
more social amelioration. So I think that's a good. I think that's going to happen. But I'm more in the camp that we need to spend more. Yes, definitely, fiscal deficits will create a burden for us. It will cost more, but our economic recovery will depend on it. Maybe in the short term, it will increase our debt to GDP. It will increase our deficit, but our ability to bounce back or recover will actually depend on how government can prevent permanent effects. For example, permanent unemployment, permanent
Mm-hmm.
loss of businesses and bankruptcies. By spending more on in the short run, it can actually secure a better prospect in the medium term.
You were mentioning that even if we have a higher debt burden now, it's okay. We will actually manage to get that back. But the government is also looking at new revenue streams. For instance, they're taxing the e-commerce. There's a 12% VAT on digital transactions. Pogos as well, which have actually been very directly linked to the Pogos simply leaving, and the real estate sector having a lot of issues because of that. Is that the right approach to be revenue generating, to be able to temporarily have more stimulus?
Well, actually, I'd actually go the other way and say that we need to actually cut our taxes, in fact. So, for example, the CREATE
Okay.
bill, which was mentioned by the president in the SONA, would cut corporate income tax. It would rationalize and restructure our fiscal incentives. I think those things are necessary because we need to provide relief for the many businesses that have been affected. I think
Mm-hmm.
taxes on internet transactions or online transactions, for example, might hamper, in fact, economic activity. And I think the business community has already spoken against such measures because it would just, create a burden for small businesses to undergo their transactions online, for example. But as regards to specific examples like Pogos, I think it's rational to tax them more, for example. But um, as a general policy direction, I think it might be better to pursue a more stimulus approach, which is to cut taxes and to spend more.
Okay, and so in that case, you mentioned the debt is another option here. Is that worth risking our credit rating for?
Well, I don't think that increasing the debt or deficit ratio would necessarily hurt our credit rating. Right now, we're in a very good position. We have large foreign reserves, for example, and actually our debt is mostly sourced from domestic debt at the moment. So it won't hurt our credit rating. Remember that this recession is not caused by bad macroeconomic fundamentals, but by an external pandemic shock. So
Mm-hmm.
our credit rating, since it's based on our macroeconomic fundamentals, which remain to be strong outside of this pandemic, I don't think it will be necessarily affected by it. What will dictate our economic recovery really is how the government is able to contain the pandemic, how it's able to show
Okay.
that it has a roadmap to containing the pandemic, so that we don't have to resort to lockdowns in the future. We can finally end the community quarantine, but at the same time, it should be able to protect the economy by pumping money into small businesses, by providing relief for self-employed, for informal economy workers, etc.
A lot of analysts have said that the Banco Central has been the one pulling the weight here in terms of policy and monetary easing, for example, and they've already cut the interest rate to record low. They've already put in liquidity, but that liquidity is not necessarily being mopped up. They've actually reported that banks are even more stringent in terms of lending. The MSMEs are having a very difficult time just to survive 3 months, according to the ADB. So what is going on, and why is there this disconnect between the funds that are available and that the banks can actually now take away from their reserve requirement, and the small MSMEs that need this money that are not able to get it?
Right. That's correct. There's a lot of money already available. The policy rate is already low, and it's a lot lower than was expected. I think there's a problem probably with there could be a problem with the requirements for MSMEs, for example, to avail of these loans. There might be documentary requirements that need to be eased up. But I think a lot of it plays also when it comes to expectations. remember that the money market will really respond to expectations of the future of how our economy will fare. So uh, if we do a better job of projecting good expectations of a bounce back, probably by next year, for example, it could
Okay.
encourage firms and enterprises to borrow more money and to spend that money that's being pumped into the economy.
So it's not a matter of the liquidity; it's a matter of the trust and confidence in action in the future and the recovery path.
Right. I think that's one
AJ,
key. Yeah.
another plan of the government is to possibly take equity stakes in ailing companies. There have been talks of that happening in the airline industry. The airline industry has been waiting for stimulus and for help, especially for the workers that have been laid off. Is this a good approach, you think, when we talk about economic recovery?
Well, uh, as regards airlines, for example, I do think that the airlines industry is a key industry, it's a key sector, because it has to do with our transportation, our logistics, for example. But if the government is considering to bail out the airline sector, it has to do so with conditionalities. It can't just provide bailouts without those conditionalities. It could be conditioned on reforms in the sector. It could be conditioned on, for example, job creation in the sector or um, I think job retainment in the sector, because um, thousands of employees are losing their jobs in those sectors. So if the government is going to bail out those sectors, it should be conditioned on not them paying back their stockholders, for example, but rather on retaining workers to be employed in those sectors.
Okay, so just survival and not necessarily profit-based stimulus there. Last question, AJ. On the regulated firms, there was a lot of issues, for example, in the telco space during the President Sona that had a direct impact on the markets. You've now got Moody's saying that if the reforms are passed in Congress, we're likely to maintain our credit standing if, of course, the political issues or the political noise, let's say, gets put in the back burner. Do you think that there's a higher political risk now with everything that is going on, particularly the ABS-CBN shutdown, the water regulator still being in question, and now the telco companies as well?
I agree with that assessment that we really need to prioritize those fiscal reforms such as Arise, create those stimulus packages, and put those political distractions at the back of our minds. And I think with the way that the president delivered his SONA, for example, a lot of it was back-ended by um, personal attacks towards a certain senator, for example. He mentioned private companies more often than we would like to hear. And I think the government as a whole needs to really drop those distractions, because it needs to show that battling COVID-19 and protecting our economy is the main priority. Right now, I'm not very confident to say that the president has put those issues at the back of his mind, but I think that's something that he should, if he wants to encourage a good outlook for our economy.
Okay, so focus on keeping our economy afloat and also, and of course, containing our health to the best of their abilities. Thank you so much. It was, of course, AJ Montesa from Action for Economic Reforms.
Thank you, Danny.
And that concludes our broadcast. Today is July 31, 2020. Thank you so much for watching, and join us again next Monday, 10:30 a.m. I'm Danie Laurel, and we are One News.